Apple, over $4.25 trillion. The most popular dividend stock in America, and it's raised that dividend every single year since 2012. So does it pass my test? It doesn't. It clears 3 of the 4 rules and trips on 1. And here's the part I didn't see coming. It's not the rule you'd think. The streak's there. The dividend's covered many times over. The track record is spotless. The one it fails on is the yield. Which is strange, because Apple hands more money back to its shareholders than any company in history, just not in the form my test is looking for. So let me take you through all 4 rules on today's numbers and show you exactly where it falls down. Then I'll be straight with you. What Apple's really doing, why this is a flat no and not a maybe, and the one thing that would change my mind. Quick disclaimer first. This is not investment advice and it's not tax advice for your situation. Talk to a qualified accountant or financial advisor before you buy anything or before you sell anything. The test I'm about to walk through is the one I use for my own portfolio, on the record, every position. So, what is Apple? Honestly, you already know. The iPhone, the Mac, the watch on your wrist. There's a fair chance you're watching this on one of their products right now. The biggest company on earth. And here's the part people forget. It also pays a dividend. A small one, but a real one, raised every single year for over a decade. Which is exactly what makes it worth running through the test. So why put Apple through it at all? 3 reasons. First, this isn't some sleepy dividend stock nobody watches. It's the most searched dividend name in America, one of the most owned stocks in the country, and the biggest company on earth. If my test can't tell you whether to own Apple, then my test has a hole in it. Second, those 14 years of raises are the real thing. Apple started paying in 2012, and it's lifted the dividend every year since. That's not a company casually writing a check. That's a board that's committed. The only question is whether committed is enough. And third, Apple forces an honest question I can't dodge. It hands back more money to shareholders than any company in history. Over $700 billion spent buying back its own stock since 2012. Close to half the shares the company had back then just gone. Bought up and retired. That's a huge amount going back to shareholders. It just doesn't land in your account as cash. Does that count? Should it? Hold that thought. First, the 4 rules on today's numbers. First rule, the streak. I want at least 10 straight years of rising dividends. Apple's got 14. It started paying back in 2012, and it's pushed the dividend up every year since, usually each May. By now, it's so dependable the market prices the raise in before it even lands. Everyone knows it's coming. 14 years clears my 10-year bar comfortably. It's not in 25-year royalty territory yet, but it's well past the line that proves a company means it. So that's 1 rule down, and Apple sails through. Now the next one. This is where it gets interesting. Second rule, the cover. I want a company earning at least 1 1/3 times what it pays out, so the dividend's never at risk. Apple, it earns nearly 8 times what it pays out. Not 1.5 times, not double. Nearly 8 times over. Here's what that means. For every dollar Apple makes, only about 13 cents goes to the dividend. The other 87 cents stays in the business. And at Apple's size, that's well over $70 billion a year it could pay out, and chooses not to. The average company in the S&P 500 pays out about 40 cents on the dollar. Apple pays 1/3 of that. Its dividend is one of the safest you'll find anywhere, because they're keeping it small on purpose. So that's 2 rules down, 2 clear passes. And neither one was close. Quick favor. If you're building a dividend portfolio from scratch, like I am, this is the exact set of rules I run on every stock I buy, and plenty I don't. Subscribe, and you'll get one of these every week. Same rules, a different company each time. Okay, back to Apple. Third rule, the yield. I want it sitting somewhere between 2 and 7%. Apple's yield right now, 0.37%. That's not a little under, that's a long way under. And this is the one Apple fails. Here's why I draw the line at 2%. Below that, on a single stock, the income just isn't pulling its weight. You're taking on the risk of owning one company and barely getting paid for it. You'd do better in a plain index fund and save yourself the homework. Apple pays you about 1/5 of what the whole market does. Now, here's the part that catches people out. Apple's yield isn't tiny because the dividend is tiny. It pays out around $16 billion a year, more real dividend cash than almost any company in America. The yield only looks small because the share price is so big. The stock has simply climbed far faster than the dividend, and the yield's lower now than at any time in the last 5 years. The 5-year average is about 0.5%, and today it sits below even that. So this isn't a dip that bounces back. It's been drifting the wrong way for years. That's the one Apple fails on. And in a minute, I'll explain why it's a permanent problem, not a temporary one. One rule to go. Last rule, the discipline. No cuts in the past 5 years and no years where they froze the dividend and left it flat. Apple? 10 raises in 10 years. No cuts, no freezes, nothing. Spotless. The raises have shrunk a little lately. 4.2% 2 years ago, 4% last year, 3.8% this May. Smaller, sure, but a raise every single year. So that's the fourth and final pass. So that's the scorecard. 3 passes and 1 fail. But before I add it all up, I owe you the honest version of the Apple story. Because here's the thing, Apple is not ignoring its shareholders, not even close. It hands back more money than any company on earth, around $90 billion a year, buying back its own shares. More than $700 billion since 2012. Close to half the company, bought back and gone. That is a staggering amount of money going to the people who own it. They've just chosen to do it through buybacks instead of dividends. And if you add the two together, the dividend plus those buybacks, Apple's really handing back about 2.4% a year, which does clear my 2% line. But look closer. Almost all of that is buybacks. Almost none of it is the dividend. Now, you might be thinking, fine, so put it on a watch list, keep an eye on it, and wait for the yield to come good. But that's just it. This isn't a stock that's about to come good. Apple's board has chosen buybacks over a real dividend for more than 10 years, on purpose. Tim Cook has said it flat out more than once on their earnings calls. Buybacks are simply how they prefer to do it. They're flexible. They're tax-friendly for a lot of shareholders. And they don't lock the company into a payment forever. That's a decision, not an accident. And waiting around for a company to reverse a 10-year decision? That's not watching, that's hoping. A watch list is for a stock that stumbled and might recover. Apple hasn't stumbled. It's doing exactly what it set out to do. So this isn't a maybe, it's a no, and a permanent one. So what would actually change my mind? One thing. The yield would have to climb back over 2%. And there are only 2 ways that ever happens. Either Apple multiplies its dividend by 5 or more, paying almost $6 a share instead of just over $1, which would mean completely flipping their strategy from buybacks to dividends. Or the share price falls off a cliff. We're talking a drop of around 80%, with the dividend holding steady. Neither one is anywhere on the horizon. The stock's sitting near its highs. The dividend's creeping up a few percent a year. Nothing dramatic. Could it change one day? Of course. A new boss could decide 3 years from now that Apple should be an income stock. Boards do change their minds. But until that actually happens, my answer doesn't move. So let's add it all up. So here's the tally. The streak, 14 years, that's a pass. The cover, nearly 8 times over, yet pass. The yield, 0.37%, that's the one it fails. And the discipline, 10 raises in 10 years, no slip-ups, comfortably a pass. 3 out of 4. So Apple doesn't get through. And look, that result actually says something good about Apple. It's one of the most disciplined companies with money you'll ever come across. The streak is real, the dividend is rock solid. The only thing it fails on is one rule. And it fails because the company chose a completely different path, not because anything's broken. But it still doesn't earn a place in my portfolio, because by my rules, Apple just isn't a dividend stock. It's a brilliant company that hands money back a different way. If you want Apple, you buy it for the buybacks and the growth. You don't buy it for the income, because the income barely moves the needle. And my rules are about the dividend for a reason. That income, growing and landing year after year, is the thing that compounds. And honestly, I just love watching those payments come in and get a little bigger every single year. Apple doesn't make the list today, so the snowball grows somewhere else, and that's Apple. Run through all 4 rules. If this was useful, go ahead and subscribe. It genuinely helps. And tell me which stock I should put through the ringer next. Just drop the ticker in the comments. Because in the end, the test is the receipt.